So I get the question a lot too of, how much money do I got to put down?
Yeah.
Is it 20% down? Is it 3% down?
Sure.
I've heard about these no money down
Yeah.
loans. So there's lots of different loan programs. Correct me if I'm wrong, but you probably can't say this one's for this person, this one's for that person.
Right.
But maybe give us a kind of a high level view of, these are the different loan programs that you could.
Yeah, so high level is really, and obviously compliance wise, we can't say, hey, yeah, if you're this, you're this. Obviously, we just have to kind of keep it up here. But there's four main loan types in the lending world, and it's conventional, there's FHA, VA, and USDA, right? And so the biggest thing is we always ask people, where do you want to end up, right? And the reason why we ask that is because the USDA loan is a no money down loan, okay? So
where do you want to end up as in, where do you want to live?
Where do you want to live, right?
Okay.
So USDA, like the community of Ames and Ankeny and Des Moines, the population's too large and it doesn't qualify for USDA. So if someone says, hey, I want to definitely live in Ames, then we know we can't go the USDA option, right? USDA, kind of high level, is no money down. It's a great loan program. There's still closing costs and stuff like that, but it's a no money down option for someone that's maybe getting started and they want to live in Nevada or Boone or Huxley or just a smaller community. FHA, it's a great loan option for someone probably rebuilding credit, maybe a little bit lower on the credit scale, and with that, it's a 3.5% down payment. Okay, in Ames, if you say, hey, I have to be in Ames, FHA qualifies for Ames, so that's a great loan option there. The VA is your eligibility is only allowed if you're a vet, and then depending on your discharge, kind of with those qualifying. So VA is a no money down option. VA is the only way you can buy into a large community with no money down. So like the Ankeny and Ames, like I was saying before, the only way you can get into that community with a mortgage would be through a VA without a down payment. And then conventional, that loan is designed for maybe a little bit higher credit, and then obviously someone who has the assets for down payment. And again, my job is to kind of take the borrower and fit them in the best program for them.
Right.
So if you're sitting there and you're like, I think I want to do this, don't lose sleep, because that's my job, is to try to help.
So the moral of the story
Yeah.
is there's a brief overview, and then
a lot to do. Yeah.
Talk with Gavin. He'll look over,
Right.
what you have for cash in the bank,
Yep.
where you want to be at for payments,
All that fun stuff.
and that kind of leads me to the next question
Yep.
is pre-approval. Why
Yeah.
is pre-approval important? A lot of times you might be watching this and you might have just clicked on your first house that you're interested in looking at, or just started thinking
Right.
about looking for a house and you're going to buy next 6 months from now or whatever. Does it make sense to talk with you now?
Now.
I'm looking to buy in the spring. Let's say it's fall now. We're
Right.
buying in the spring.
Right.
Um,
Yeah, and I mean, honestly, we run into a lot too in the spring, where we know Ames rentals are all up at the end of July,
Yeah.
right? So we
Oh,
always
yeah,
say, hey,
a
let's start talking to them in February, right? So pre-approvals are, it's the number one leverage piece that a borrower can have when trying to find a home, right? Like, is that fair? Probably say.
Yeah. Yes.
So when we form a pre-approval and we send that out, that is basically Fairway saying, hey, there's enough meat on the bones on the profile that, hey, we agree that we can pre-approve you for this much. And so the important part of it is that we do our due diligence on the front end to make sure that we don't have any surprises that we can control throughout the process, right? So obviously things come up, headaches arise, stuff that we don't know pops up. But for the most part, that pre-approval is really, really important, because we verify your assets, we verify your income, we verify the credit score, and we verify employment. And all those things really kind of make up the meat and potatoes of a mortgage underwriting process. And that's why when we send that out, we feel really, really good about it when they're trying to find a home.
So when someone could meet with you 6 months early, kind of go over a brief overview
Yep.
of this is what we got.
Yep.
Do you pull credit at that time?
Yeah, so it's really up to the borrower. It really
Okay.
is. So when we pull credit, that and say it's a qualifying score and everything's good, right?
Yeah.
So that pre-approval is good for 60 to 90 days from that day of credit pull on, right?
Gotcha.
And the reason why is because credit reports are only good for that long,
Right.
So once you hit today 61 or 91, that credit report is no longer valid. It's dead, right? So that's why that pre-approval is only good for that long. So what happens is so if we meet with somebody, say today, but they aren't really looking until next March, is we can kind of know where things are at, and we can say, hey, rather than wasting your time looking at this wide of a price range, why don't you kind of look more here? And then once we get to January, right, then we'll pull credit, and then we'll be really, really accurate with it. But
and maybe it helps too.
Yeah.
You got to get some stuff shuffled around.
Absolutely.
You got to pay off some bills. You got to
Right.
do this. We're 6 months out.
And the other part to think about too is it's okay for us to pull that credit again. A lot of times people are really concerned about, hey, don't pull my credit again.
Right.
What they don't realize is we're a mortgage pull. So a mortgage pull, essentially, when we pull your credit, it doesn't affect your credit score because we're a mortgage pull, right? The other thing is that after 60 days, that falls off your credit report as your inquiry, right? Okay. So in the event that, say we pulled it today, but you don't want to buy until January or February, and we pull it again in January, your credit score is not going to be affected because we're a mortgage pull and it should fall off by then. Does that kind of make sense?
That makes sense.
So,
I heard too that if you had multiple mortgage pulls within the same week or something like that, it
doesn't affect you. So you have from the time of your first pull, you have 2 weeks or 14 days, and you can have 3 credit pulls on your mortgage.
So they can shop every bank in town.
Yeah, well, don't want to do that. You can just talk to them. But you have 3, and then it shouldn't affect. If you have your 4th one, then that's going to impact the score. I've been told maybe like 4 to 6 points. So not huge. Right. Now, obviously, on the contrary, right? If you would go and get an auto loan or a credit card and they'd pull your credit score, that's going to drop you because that's a consumer debt, right?
Gotcha.
With a mortgage debt, that doesn't drop that credit score because it's a different quote unquote pull on that credit.
Really?
Yep.
Fantastic.
There it is.